Chapter 10. Market Meltdowns. If you have trouble imagining a 20% loss in the stock market, you shouldn't be in stocks. John Bogle. Capital markets work like pendulums that spend very little time in the middle. Physics tells us that if there is no external force applied, a pendulum should stay in the exact middle, that is the center of its gravity. However, once a force is applied, the pendulum starts moving in a direction. The greater the force, the faster and farther it travels in that direction, but it gathers potential energy in the process. The farther it travels in one direction, the greater amount of potential energy it accumulates. Once it stops going in that direction, it turns back and travels in the other direction. The higher it goes, the faster it comes. It does not stop in the middle, but keeps going in the other direction, and the cycle continues. Capital markets work the same. The equilibrium point is the fair value of an asset, the discounted value of all future cash receipts. However, hardly any stock is sold at its fair value. In the case of markets, the external force is its participants and their emotions. They move the market in one direction far from its rational point, and when the tide turns, they start pushing the pendulum into the other direction. We call it market cycles. After an excessive bull run, generally, a bear market comes. The textbook definition of a bear market is a downward move of 20% or more from a recent high. However, on average, stocks generally go down by 30% in a typical bear market. It is not essential to know when a bear market or a significant downturn will come. Nobody can predict it consistently. Some people claim that they predicted a downturn, but they forecast a downturn every day, and finally, one day, they are right. Even a broken clock is right twice a day. Predicting a downturn is not critical. The important thing is what you do when a significant downturn happens. The way to make money is to buy when blood is running in the streets. John D. Rockefeller. Bear markets are healthy and routinely happen every 3 to 5 years. Generally, bear markets last only a few months. However, sometimes bear markets turn into major downturns of around 50%. Market drops of more than 50% are infrequent and have happened only a couple of times in the last 100 years. Causes and signs of market meltdowns. Signs of a significant market collapse are very evident and offer tremendous opportunities, but very few people take advantage of these once-in-a-lifetime possibilities. Let's discuss some of the characteristics of a major market meltdown. 1. Liquidity collapse. 2. A universal belief that prices have fallen permanently. 3. Widespread complaints about the behavior of risky assets. 4. Sweeping flights to safety. 5. Presence of universal pessimism. 6. The disappearance of all financial gurus, advisors, and enablers. 7. People start selling their entire portfolios and make promises to never invest in risk assets again. 8. Stories of people losing their life savings and retirement funds become everyday talk. 9. Fear of losing all dominates the overall analysis of fair values and risk and rewards. 10. Cash is king becomes a common phrase. When you see these signs, it is time to take maximum advantage. You should start buying aggressively. Remember, you need to buy at a bottom, not at the bottom. Cape Town, South Africa, is situated close to the bottom of the African continent. This place is called the Cape of Good Hope because, in the old days, at this point, ships used to turn around and start their journey towards the north. Market bottoms are the Cape of Good Hope for investors. You need to buy around that cape, not necessarily at the very tip. You get recessions, you have stock market declines. If you don't understand what's going to happen, then you're not ready. You won't do well in the markets. Peter Lynch. Let's discuss the signs of the market collapse and bottoms. Liquidity collapse. Liquidity is the fuel of market bubbles. Without excess liquidity, bubbles cannot form. At the start of a downturn, liquidity starts to shrink. Banks become hesitant to provide capital, and investors are reluctant to borrow more money. Good companies start focusing on paying back the loans instead of borrowing more money for capital projects. A rising interest rate contributes to the liquidity shortage, and if the government decides to raise the rate at the wrong time, liquidity significantly contracts. When the prominent market participants believe that the market is having a liquidity crisis, they quickly act to protect their interests and pull out from every asset wherever possible. The banks and other market players stop making loans and even refuse overnight lending to each other. Nobody trusts anybody else. The financial viability of every institution is questioned, no matter how large an institution is. We recently witnessed the complete collapse of the liquidity in the 2008 financial crisis at its peak. For a couple of weeks, money just stopped flowing. No bank was spared. The solvency and economic viability of every institution was challenged. Liquidity collapse is not the sign of the market bottom. It is instead a sign that the bottom is not far. Lehman Brothers filed for Chapter 11 bankruptcy protection in September 2008, and the market reached its ultimate bottom in March 2009. After the Lehman Brothers collapse, the next couple of months were particularly hard for liquidity flow. Even non-financial companies were begging for funds just to stay afloat. Those were good companies, but needed routine flow of money between banks to make and receive funds from other companies. The governments worldwide started a collaborative effort to provide enough support and liquidity to restart the economy. Money was made available within a couple of months. However, stocks kept going down for another 4 months. Warren Buffett and other seasoned investors knew that the end was near. On October 16, 2008, Warren Buffett published his famous article, Buy American, I Am. This letter was published exactly 1 month after the Lehman Brothers bankruptcy filing. I highly encourage you to read this article with an understanding that it was written at the height of the financial crisis. It was written when everybody thought that the American economy, as we know it, had ended. A liquidity crisis is part of all market collapses and meltdowns one way or the other. The Panic of 1907, the stock market crash of 1929, and the Great Depression, the oil embargo of 1973, and most recently, the global pandemic of 2020. A liquidity crisis is ended by government actions and by government actions only. When you see that governments are providing liquidity support or have started talking about it, it is the time to start buying. A universal belief that prices will keep falling or have fallen permanently. At the peak of all meltdowns, people think that stock prices will keep falling or have fallen permanently. The market will never come back. The economy has collapsed and will not turn around for decades to come. People sell their portfolios and move their capital to cash. There is an excellent characteristic of stock investment that it can only go to zero. It can never cause you more financial harm than the amount of your original investment, unless you are playing with margin financing, options, futures, or some other exotic instrument. If your investment is in pure stocks, then your downside is limited. You must understand that assets are becoming less risky with every percentage down. Say your stock is sitting at the top of an all-time high of $100 per share. At this point, your potential risk of loss is $100 per share. If the price drops 10%, then the potential risk of loss drops to $90 per share. If it falls 50%, then the potential risk is $50 per share. My point is that with every percentage drop, your risk is reducing, not increasing. That's why 10% drops are more common than 50% drops. So, the notion that prices will keep dropping after a considerable meltdown is baseless. Sure, prices can go further down, but the likelihood is reduced significantly. In 2008, the market fell by almost 60%. This is about a 20% further decline from the point of 50% drop. It was painful, but the market turned around within no time, and within the next 12 months, the market was up by almost 70%. Look at the 2020 pandemic market crash. The market fell with phenomenal speed, only matched by the great market crash of 1929. However, within no time, the market turned around and made new highs. It was the quickest turnaround in American stock market history. Now consider another part of common belief during market meltdowns. Prices have fallen permanently or for a very long time. This belief is not entirely baseless. There are 3 examples in the past 100 years. The The first one was from 1929, when prices dropped by almost 90% in about 3 years, from 1929 to 1932. After that, stocks turned around and recovered about 70% of their previous highs by 1937. Then they fell again and didn't make an all-time high until 1954, a long, long time of 22 years. Let's analyze this a bit further. It started with a market bubble of the Roaring '20s. Stocks were significantly inflated in the first place, so the first 30 to 50% drop was in fact a correction. However, from the market bottom to a new all-time high in 1954, the market still managed to produce a respectable 11% per year. Don't forget that this period had a great economic depression of 10 years and a 6-year-long world war that claimed millions of people's lives and collapsed economies worldwide. The second example is the period from 1973 to 1980, or more broadly, from 1968 to 1982, a period of about 14 years. During this time, the market attempted several times to make a new high but collapsed again. It briefly achieved a new high a couple of times before collapsing. Finally, it broke free in 1982 and kept making new highs until the year 2000, despite a 22% one-day drop of 1987. The period between 1968 to 1981 was a period of extreme political unrest. The Vietnam War, the Arab-Israel War, the oil embargo, the Cold War are just a few to name. However, during that period, the American economy was doing just fine. It was political unrest that was not allowing the market to make new highs. During that period, the valuation matrix dropped to the floor. P/E ratio fell to 6.68 in March 1980. Stocks were so inexpensive for so long. It was the best period to accumulate wealth, but very few people took advantage of this 14-year-long sale. When stocks finally broke free, they kept going up for the next 18 years until the next market meltdown of the dot-com bubble. This period gives us an important lesson. When you buy a stock, you buy a piece of business, not a quote from a broker. As long as the company is doing good, your investment is safe. It is irrelevant what daily quotes are unless you want to sell. Warren Buffett has advised many times that if you are a net buyer of businesses, you should be happy with lower prices because you can buy a larger percentage of the company with fewer dollars. The third period of long-term price stagnation is from 2000 to 2011, the lost decade. Again, this period was preceded by the dot-com era's market bubble like 1929, and again followed by above-average returns for the next 10 years, like 1982 to 2000. Stocks briefly made a new high in 2007 before collapsing to previous lows, thanks to the real estate bubble and the resulting collapse of the financial system in 2008. Every decade or so, dark clouds will fill the economic skies and they will briefly rain gold. Warren Buffett. Widespread complaints about the behavior of risky assets. In a significant downturn, you hear a lot of complaints about how risky capital markets are. If you discuss any investment idea with anyone, they will tell you that markets are significantly risky. It is better to be outside of any investment. People don't realize that after a significant downturn, markets become less risky. If you are standing at precisely the South Pole, it will be north whichever direction you go. You cannot travel in any other direction. Exactly like this, after a significant drop, markets can only go in one direction, up. Prices always take the path of least resistance. After a significant drop, the path of least resistance is up. You need to realize that any investment at the bear market's peak has a significantly higher risk-reward ratio. Sweeping flights to safety. It is bizarre that people take a flight to safety by selling most of their portfolio at the peak of a downturn or very close to the actual bottom. Perhaps they want to avoid the pain of falling prices and the pain of vanishing profits right in front of their eyes. Presence of widespread pessimism. After every significant downturn of the capital markets, investors become extremely pessimistic and bitter about investments. Nobody has anything nice to say. People avoid talking about their investments. Needless to say, this is the best time to buy. Would you rather pay 6 times earnings or 20 times earnings for the same asset? If you are buying an apartment to rent, what price will make you happier? 20 times of annual rent or 10 times? If annual rent has not changed, then you should be more comfortable if the price of an apartment is cut in half. However, people relate their success in stocks with market prices rather than underlying business. This behavior stems from their original investment thesis of buying based on price entirely. If the prices were the motivation for buying, all future behavior and decisions would be based on price action. In a bull market, people check their investments daily and feel good with big fat profits. When the price drops, this number gets smaller. If an increase in price makes you happy, surely a price drop will make you sad. Disappearance of all financial gurus, advisors, and enablers. One thing that happens for sure in a market downturn is the sudden disappearance of financial gurus and advisors who were beating up the drum in the preceding bull market. They vanish as if they never existed. If these people are so confident about their investment advice, why don't they stay and face the music? Why don't they let people know that this is temporary and their investment advice is based on concrete financial facts? The only people who keep defending the investments are those who are holding the bag. These are the people who believed those gurus and invested a significant portion of their life savings. When a downturn sets in and it is evident that their investment advice was all bogus, all gurus and advisors go away or try to highlight the finely printed disclaimers and cautions. They point out a sentence or two of prudence in their hours-long speeches of insanity. Sometimes the behavior of these advisors and enablers touches the boundaries of fraud and criminality. Investigations are opened. Parliamentary inquiries are initiated. People are charged, but retail investors already lost their life savings, and no research or inquiry can return their money. People start selling their entire portfolios and make promises to never gamble in risk assets again. Right at the peak of the market downturn, the general public starts selling their entire portfolios. They vow never to come back. They promise to never gamble in risky assets. Yes, when they sell the portfolio, they change the terminology from once-in-a-lifetime investment to gamble. It is an established fact that most of the new net money is poured right at the peak of a bubble, and most of the net outflow happens right at the bottom of the downturn. Greed pulls people in, and fear pushes them out. Stories of people losing their life savings and retirement funds become common talk. In a bubble, people love to tell stories of their friend's friend who became an overnight millionaire. The exact opposite happens in market downturns. People tell stories of others who lost most of their savings, houses, and retirement funds. People tell those stories not to scare others, but to console themselves that they didn't lose their entire account. Sure, they lost some, but they looked at this person who went crazy and eventually lost everything. They feel better by comparing themselves with others who did worse than them. People like to win to feel better. A smaller loss is better than a significant loss. That's why they tell these stories. Another group of people who are really active in telling their stories during the peak of market downturns are those who have sold their investments, and the market kept going down. A friend of mine had a couple of apartments in a large US city. He sold his apartments at a significant loss in late 2008. The market kept going down, and he kept bragging about his timely sale for about a year. Surely, he never repurchased properties even when the market started going back up again. Another friend discussed his situation with me before selling his property. His problem was that he was not able to find a suitable tenant. My first question was, how much loss will you incur if you sell the apartment now? He said about $100,000. My next question was, how much rent are you expecting? And he told me about $1,500. I told him, if you don't sell the apartment and don't rent it out for the next 5 years, you will still be better off. It will take you 5.5 years to incur $100,000 loss. Why do you want to take the loss now? He agreed with the logic and decided to keep the apartment, and in a few months, he found a tenant. The market value of the property came back in a few years. The critical question in this story is, why did he want to sell the apartment at a huge loss? To avoid the pain of losing $1,500 cash every month for an unknown period. That was the core of his decision to take the big loss because he wanted to know the amount of his ultimate loss. He wanted an escape from the unknown to the known. The known is comfortable and easy. The unknown is painful and gut-wrenching. This is the reason people sell at the height of a market downturn. Fear of losing all dominates overall analysis of fair values, risk, and rewards. In a significant downturn, people act upon their fear of losing all. They don't realize that the price they are watching in horror is only the last transaction for a tiny number of shares, and that transaction is between only two parties and only one is a seller. The other party is the buyer who found the price attractive enough to make the purchase. Every transaction, irrespective of how low the price is, proves one fact, that there is a buyer on the other side. Somebody is buying. I would fear more of an illiquid market where the price of a tradable asset is not moving at all. It happens because there is no buyer. Fear of losing all is extremely powerful and forces people to make illogical decisions. People throw all analysis of fair values, risk, and rewards out of the window and stay glued to the computer screen, looking at prices as they keep going down. Once it crosses their threshold, they push the button and come out of the investment. It relaxes their emotions as they are now in the no more loss territory. Looking at sharply dropping prices is not easy. The best cure is to not look at the prices at all. Always remember that the minority dictates the prices and the majority governs the value. Focus on value. Stock investment is not buying a quote or a price on your screen. It is a proportionate share in a business, and that business may be thriving despite a significant price drop. A loss is an actual loss only when you sell the asset. If you don't sell the asset, your loss is a paper loss, irrespective of how significant that number is. By the way, it is true for paper profits too. When you sell your asset to somebody else at a loss and the underlying business is thriving, you sell your dollars for dimes. When people are ready to sell their dollars for dimes, you should be the buyer, or at least not be the seller. Cash is king becomes a common phrase. When you hear this phrase a lot, it is time to convert all of your cash and any cash that is available to you at a reasonable price into earning assets. Cash is never a king, especially when people repeat the phrase often. Cash is a terrible investment. It earns nothing. It suffers inflation loss. It suffers the risk of physical loss. If you deposit your cash with a bank in a savings account, it is no longer cash. You converted your money into a debt instrument and added credit risk in exchange for physical loss risk. Cash in your bank account is as safe as the credit worthiness of your banker. No more, no less. Chapter takeaways. It is not essential to know when the market will go down. The important thing is what you do when it does. All common investments have a great feature. The maximum amount you can lose is your capital. It is easier to know the bust rather than a bubble. When people start selling their dollar bills for dimes, you know the end is near. You must not be a seller if not a buyer in a massive downturn.